Anne, no. Esther, Niharika, no. Rachel, Korchika is not here, Manuela is here, Shamala, Rushani, no. Craig, no. Prem, Dora, Cindy, no. James, no. Rupa, where's Sasha? Lucky last week. Okay. Okay, so in case you didn't realise, there were already answers up on Blackboard to a couple of the questions. So 10.7 and 11.1, the solutions were there for those of you that are able to keep up as you're going. But we'll go through all of them today. So 10.6 and 10.7 are the emphasis. So the 10.6, 10.7 are quite similar in terms of how you have to deal with them, but you've got to read them differently. Well, if you go over to page 4, you can see 10.7 is laid out just a little bit differently. You've got to figure it out, and it's acquired in a two-step process. So there's just one slightly different little thing to it. So it's a little bit harder, a little bit more reading, but the end result of the question is very, very similar. All right. So 10.6, we have to prepare our consolidation worksheet adjustments as at the 1st of July and the 30th of June 2020. So at the beginning when the acquisition happened, and at the end. So there's three main things you have to do. Number one, you have to do your acquisition analysis. Right? As a part of that acquisition analysis, you have to tax effect the difference between the fair value and the carrying amounts of identifiable assets and liabilities being acquired. Right? So that's your step one, acquisition analysis. Step two, we have to do our worksheet entries, where we account for our business combination valuation entries that are tax affected. And then the last is our pre-acquisition entry. Right, and then, because we're doing it at the beginning and 1 year later, normally 1 year later you have to think about, are any of the items that we've included in that acquisition analysis changed? So if it's inventory, has it been sold? Is there depreciation on plant and equipment? You have to think about. If there's any contingent liabilities, have they changed? If there's any goodwill, is it impaired? All right, so when you get into later years, that's what you have to think about, how the entries might have changed. So if we have a look at 10.6, reading through the question in front of you, we've got, on the 1st of July, Mutt acquired all the issued shares of Jeff for $174,800. Right, so that's your consideration. So big circle or highlight that, because that's what you're going to pay. That's what you're going to use to work out whether we've got goodwill or a gain on bargain purchase, because that's what we've paid. At this date, the equity consisted of share capital of 80, retained earnings of 68,800. So that's the first line of your acquisition analysis when we get there. But we've also got patent or plant and equipment there. So it's just got plant there, but I think in the solution they talk about equipment. So just make sure you just write equipment next to it so you don't get confused. The carrying amount versus the fair value, there's a difference there of 8,000. There's 12,000 with the patent, so you might want to write these down on it. Inventory, all right, and there's a, 6,400 difference. So the patent was considered to have an indefinite life. It was calculated that the plant had a further 10-year life. So that 10 years, you might want to highlight that, because in later years, the depreciation, we're going to have to look at the difference in that carrying amount and write that off over that amount over the next 10 years. It's straight line depreciation as well. All the inventory was sold by the 30th of June 2020. Jeff conducted an impairment testing on the patent. It was still considered to have an indefinite life, but then there was goodwill as part of that impairment testing that was considered to be impaired by about 1,200. So we're going to have to do an adjustment for that 1,200. Right, so also in May 2020, so that's before the end of 30th of June 2020, there's been a transfer from retained earnings to the general reserve. We're still going to assume the tax rate is 30%. Okay, step 1, acquisition analysis. All right, let's have a look. Okay, so our difference between our fair value and our carrying amount of our patent is 12. Our equipment there is 8,000 and 6,400 for our inventory. Okay, so do our acquisition analysis. So what you used to do before under AASB 3 when we did business combinations earlier. All right, it's the same. So first line there is your equity. Right, you might want to write along. Okay, make sure you're writing as you're going along because it helps with your study. Your inventory, the difference between your carrying amount and the fair value of 6,400, we want to tax affect that. Right, so we're only going to include 70%. 12,000 for the patent, 8,000 for the plant. Add them all up together gives us 167,280. We are only going to pay 174,800. So we've got goodwill of 7,520. All right, nice easy question. Gets a little bit harder when we do 10.7 a bit later. We've got pre-existing goodwill. We've also got a cumulative dividend that we'll need to account for. So this one's, that's why I'm doing this one first, because it's an easy one. Then we'll do 10.7 because it gets a bit harder. All right, so that's step 1. That's your acquisition analysis. We've identified that we've got goodwill of 7,520. Step 2 is we've got to take those valuations here and we have to prepare our business combination valuation entries. Right. So we're going to have an entry for inventory, the patent and the equipment, the plant and equipment, and we're going to have an entry there for goodwill. So just go slow so you get it all down. Okay, step 2, let's do our business combination valuation entries. Number 1, let's do our inventory first. All right, so we have to increase the value of our inventory because the fair value was higher than the carrying amount. So we're going to debit our inventory 6,400. All right, we're going to put 30% of that. So 30%, 6,400 is 1,920. If you need to, grab your calculator so that you're adding it up as you're going along. Right, and the difference, which is the 70%, is going to go to our business combination valuation reserve, 4,480. Next is our patent. We have to recognise that the patent's fair value was worth a bit more, so patent is an asset. We're going to debit it by $12,000. 30% of that is $3,600, and the difference, $8,400, is going to go to our business combination valuation reserve. So instead of writing that all out in full, for deferred tax liability, you can write DTL, business combination valuation reserve, you can write BCVR. Save a bit of time. I'm happy if you do that in the exam as well, because it's pretty clear what it is. So deferred tax liability, DTL, and if it was an asset, DTA, business combination valuation reserve, BCVR. And remember this if you're visualising the worksheet in front of you. So remember, we're preparing, these are part of our consolidation worksheet entries. Maybe you have the parent in one column in your spreadsheet, you've got the subsidiary in the other column, and then you've got these entries that you're adjusting as you're going through. All right, so debit, credit, so that we make sure we've got the group accounts reflecting the assets and liabilities of both the parent and the subsidiary when we're adding them together. Okay, our depreciation, there's two ways that you can do it. Number one, you can write back the depreciation. So the original cost of the equipment was $80,000 and the carrying amount there is $40,000, right? That means the accumulated depreciation must have been $40,000. So we're going to write that back, because currently in the books in there is a credit at $40,000 to take it back. To remove it, we're going to debit accumulated depreciation $40,000. We're going to credit the equipment $40,000. To increase the value of our equipment now, because the difference between the carrying amount and the fair value is $8,000, we can debit equipment $8,000, right? And now we tax affect it, so we're going to credit the deferred tax liability $2,400 and our business combination valuation reserve with a difference $5,600. Alternatively, you can write back the depreciation $40,000 and you can credit the equipment $32,000. Right, which is these joined together. So you can do it in a single journal entry by writing back the depreciation and only crediting the equipment by $32,000. Right, still recognising the equipment at $40,000, because remember, in the books it's sitting in there at 40. We add the two together, add the 40 to the 48, minus out the 32. To make sure that it's currently sitting in our books at that 48. We've got a deferred tax liability there of 30% of the $8,000 for $2,400 and the 70% of the $5,600. So there's one journal is the same as those two. So you decide which way you want to do it, what makes more sense to you. For me, as I'm going through it, writing back the depreciation and then adding in the $8,000 always makes it very clear that that is 30% of the $8,000 and that's 70%. So for me, I would be more inclined to do the two. It doesn't take much extra time. Okay, last one, we have to account for the goodwill in our business combination valuation reserve. Right, so we have to debit goodwill, $7,520, credit the business combination valuation reserve, $7,520. All right, so what that means is we've got a few entries in our business combination valuation reserve account. Remember, the next step is our pre-acquisition entry. We have to bring that back to nil. So if we go back to the beginning, let's have a look at the first couple. We've got inventory. So we've got 4,480. We've got 8,400. We've got another 5,600. And now we've got the goodwill of 7,520. those all added up together, we need to remove and include in our next entry, which is our pre-acquisition entry. Right, so add them all up, do a little T account, inventory, patent, goodwill, and our equipment. Plant and equipment. And our goodwill all add up to 26,000. Right, that 26,000 comes out in our pre-acquisition entry here on the debit side. So our pre-acquisition entry, the effect of that is to zero out the equity of the subsidiary. So the subsidiary has currently got 68,800 and 80,000 sitting on the credit side in their books. Right, we need to zero that out. So we're going to debit it so we don't double dip. So that all we're showing in consolidation is the assets and liabilities of the parent and the subsidiary. All right, so we've got our 68,800 from the first line of our acquisition analysis, our share capital, business combination reserve of 26,000. Then what we paid 174,800. So the purpose of our pre-acquisition entry is to bring the equity of the subsidiary to nil and to zero out our business combination valuation reserve and recognise the shares in the subsidiary. Well, adjust for the shares in the subsidiary because the shares in the subsidiary, remember, are currently sitting in the books of the parent. As a debit, we've got to take them out. Right, so what that means is only the assets and liabilities are being reflected in the consolidated accounts. All right, so that's the initial journal entries, but it asks us to do a journal entries for 1st of July, which we've just done, but also the 30th of June, which is 1 year later. Some journals will stay the same. Remember, you have to do it every year. Some journals will stay the same and some will be different because as transactions occur, they may change. Inventory sold, we have to adjust the cost of sales. If there's impairment, we have to adjust that. We've also got to transfer from a reserve as well. So there's an impairment and an adjustment. Okay. So the future entry, so over that year, so when we're doing our accounts at the end of the year, 1 year later, we've got the sale of inventory, so we have to account for that. That's part of our cost of sales now. The depreciation of the plant, so if you read here, it says our depreciation on our plant, it's going to be straight line over the next 10 years. So that means that worksheet entry we did for the plant and equipment, we have to account for that. All right, we have to account for 1 year's depreciation and the tax component of that. That's for 1 year. Then if we do it again, there will be 1 year in the current year and 1 year goes to retained earnings. So I'll show you that as well, even though it's not required. The goodwill impairment of 1,200 as well, we have to account for that. All right, so if we have a look at our original entry, so all the inventory is now sold. So this was the first entry that we did when we did our business combination valuation entry. Debit our inventory 6,400 because we needed to increase it to the fair value. The deferred tax liability of that was 30%. Our business combination 4,480. It's now sold. So our inventory account now, it's not in there, it's in the cost of sales. So we need to adjust that cost of sales by 6,400. Income tax expense 1,920, and we're going to use another clearing account called the transfer from a business combination valuation reserve. All right. And so that clearing account, when we get to it, there will be another entry for that you'll see as we go through with our pre-acquisition entry. All right, so it's all sold now. And what that means is in the next year, it would already have been accounted for through the retained earnings. All right. So this was the original entry in the worksheet. We don't have to do that in the second year, it's already done. Right, we're doing a new worksheet this year. Now this is what we would be doing at 30th of June 2020. All right. So I'm just showing you as we're going through this what we originally did. Now it's a new time. We have to do it again because it has to be redone every year. So we don't do both, we just do this one at 2020. Hang on. Okay, next one, the patent. There's been no change to the patent. It hasn't been impaired. It's fine. So we need to do that journal entry again. So we're going to debit our patent to increase the value of that patent in our books, 12,000. The tax component of that, 30%, 3,600. And our business combination valuation reserve is 8,400. All right, that was just for illustrative purposes, just showing you the difference, and that's what the original entry came from. Okay, the next one, our depreciation. There's no change to the original entry, right? Original entry is the same. We're going to do the quick one, the one where we've got depreciation that we write back, 40,000 accumulated depreciation. We're going to credit the equipment by 32. The difference between those two is 8, which is the 8,000 difference for our plant and equipment here between the 40 and the 48. We've got a deferred tax liability of 30% of that 8,000, 2,400, and the difference of 5,600. But at the end of the year, we have to have the depreciation, right? So we got that 8,000 variation that we're going to have to account for. 10 years, 8,000 divided by 10 or 10% is 800. So we're going to debit our depreciation expense by 800 and a credit accumulated depreciation by 800. Remember, the fair value is greater than the carrying amount, so we need to recognise more depreciation. Therefore, we debit depreciation, credit accumulated depreciation to increase it. Because remember, in the books of the subsidiary, it's in there at a lower amount. Right, but upon a business acquisition, we can record it at a higher amount. Had they fixed their books before the acquisition had taken place and had revalued their assets to the fair value, you wouldn't have to do any of these journal entries. All right, but that doesn't always happen. You like to try. You get 12 months to do an acquisition, so hopefully those things can be sorted so that the carrying amount and the fair value in the books of subsidiary are the same, and therefore the only things that are showing in your business acquisition are things that the subsidiary can't put in there, right? Such as intangible assets, such as contingent liabilities. So, okay. The tax effect of that depreciation as well, 30% of that $800 we need to account for. We've got a deferred tax liability there of 240 and an account for that income tax expense of 240. So 30% of that 800. So effectively what we're doing, that deferred tax liability, it's currently in there 2,400. That divided by 10 is 240, which is also 30% of the 800. We're going to write that back over the next 10 years. So it's currently in there as a credit. To get it out, we're going to debit it. So that's essentially what you're doing. Sorry, did you hear my stomach there? Growling? It was really loud. All right, so that's what we're doing. So that 2,400, 10% of that, 10 years, 240, we're going to keep writing that back. So this is 1 year. In the next year, we would have depreciation expense of 800, but accumulated depreciation would be 800 times 2, so 1,600. So that's in the next year. Right, our deferred tax liability, we're going to adjust that by double that in the next year. That's going to be 480. And in the current year, it's going to be 240. Right, so as you go forward, now we've also going to have an adjustment here in retained earnings as well, and next year we'll show you that in a minute. Okay, so our impairment losses are accounted for through the profit and loss. So goodwill is not tax affected, it's exempt. So the question told us that goodwill was impaired by 1,200. So our original entry of 7,520 doesn't change, but we do need to account for that impairment loss. Right, so our impairment loss of 1,200 and our accumulated impairment loss for the goodwill credited there for 1,200. So it gets accounted for through the profit and loss. So when we have a look at our pre-acquisition entry, right, we've got an additional entry in there, that transfer from our business combination valuation reserve. So remember we had that before for the inventory that's sold. So we're going to debit that and we're going to credit our business combination valuation reserve. So that is now 0 and our business combination valuation reserve has been adjusted. All right, the general reserve, the question says we're going to transfer some 20,000 out of our retained earnings into our general reserve. So we just do a adjustment there, transfer to your general reserve, and we've got debit our general reserve, and these are going to change. Our retained earnings are going to change. We're going to have another line item when we work out in the next year. So this is the next year after that. Notice our retained earnings has changed. All right, it was in there at 68,800, but we're going to take out 28,000 and we're going to adjust it for the inventory of 4,480, right, which gives us our retained earnings in the third year is 53,280. Our share capital stays the same. Business combination valuation reserve is reduced by the inventory that was sold. It was 26. It's now 21,520. Shares and Jeff have remained the same, and our general reserve now has got 20,000 in there. All right, so it's changed. So that's how our entries changed over time. All right, so that's a simple one. Now the next one starts to get a bit harder. So you've got this one in front of you, so you won't be able to read it all from there. So any questions there on the 10.6? All right, you see it's a pretty straightforward process. Number 1, do the acquisition analysis. Number 2, do your business combination valuation entry. So that's recognising the differences between the carrying amount and the fair value of the existing assets and adjusting for any new items that have to go in, any intangibles or contingencies. Right, this one we're going to do, and then third step is your pre-acquisition entry. Pre-acquisition entry is to write out your equity and nil out your business combination valuation reserve. 10.7, which I've already given you the answer to, is exactly the same, just presented in a different way, so it takes you a little bit longer to get through it. All right, and it's done in a 2-step process because the company Stan, they have acquired 40%. They had 40% of it already, but then they're going to acquire the rest of it. So they're 100% now. Right, so there's one extra process in here because there is a fair value of their existing 40% that we have to account. So when they're buying into it, right, what they're paying is for the 60%. So you don't have to do any calculations around that. We'll get to that. So in terms of your consideration, we'll look at that in a second. So in the year ended 30th of June, 2015, Stan had acquired 40% for $72,000. The acquisition didn't give them control, therefore there was no consolidation, right? So they didn't have to worry about it. But on the 1st of July 2019, Stan approached family members following the death of a family and persuaded them to sell the remainder of the shares. So now they've got 100% for $137,700 on a cumulative dividend basis. So that cumulative dividend basis is important. That 137 is important because if there are dividends owing, we need to take that off the consideration transferred. There's also going to be goodwill in this one as well. Stan had recorded its original investment at fair value, with the changes in fair value being recognised in the P&L. The asset was recorded at $91,800. All right, so that's your original fair value. The equity in Lee consisted of $144,000 in capital, 36 retained earnings. Right, so that's your acquisition analysis first line, but we'll get there in a minute. Included in the assets and liabilities was goodwill of $5,400. So we have to adjust for that. We're going to have to take that out when we do it. There was also some impairment losses that we're going to have to account for. And there's a dividend payable of $4,500 that we're going to have to account for. On the acquisition date, all the identifiable assets and liabilities were recorded at carrying amounts except for inventory of $39,600. So you might want to correct that in the handout. I didn't notice that. Which the fair value of $39,600 was $3,600 greater than its carrying amount. So the circle around the $3,600 because that's what we're going to have to tax effect to do our business combination valuation entries. Okay. There was equipment that's got a fair value there of $94,500 was greater than the carrying amount. The cost was 108 less accumulated depreciation there of 1,800. So we have to work out the difference there. Do that in a minute. Besides determining the fair values of the recorded assets, there was also two assets not recorded in a subsidiary. These were internally generated patents with a fair value of 45, so we've got to add them to the acquisition analysis. In-process research, which was had expensed $90,000, but had been fair valued at 18. So the 18 is what we're going to include, all right, in our acquisition analysis, because that's the fair value. Further, there was a contingent liability, which had a fair value of 9 that we're going to have to account for. So there's a tax rate there of 30%. So this one is written a bit differently, so it's a little bit harder in the sense of the way that you have to read it. All right, so it's laid out a bit differently, but it's actually not that hard. So let's have a look. So item number 2 there, we've got our equity. We've got 144 and 36 as our equity. Our inventory, we need to add 3,600 tax affected to that. Our plant and equipment, we've got to have 4,500. So we've got 108,000 minus the 18,000, which is 90,000, minus the 94,500. The difference there is 9,400. All right, tax affected. We have to minus out the goodwill. So remember, when you're doing a business acquisition analysis, any pre-existing goodwill needs to be excluded. All right. So the question said there is 5,400. So we're going to take it out of there. And we're also going to take it out down here when we work out our premium down here. We've also got to add in the assets and liabilities that are not accounted for in the subsidiary but are being taken on. So we've got the patent at 45, the research at 18, minus out the contingent liability there of 9, all tax affected. So these items, we need to account for them in our business combination valuation reserve. So we'll do all our journal entries in our little T account in a minute. Add them all up though, we've got 218,070. That's the fair value of all the assets and liabilities, but we're only going to pay 137,700. We have to minus out the dividend because it's a cumulative dividend basis. We're not paying that. All right, so we've got to take that off, gives us 133,200. The fair value of their existing 40% was 91,800. So if we add those two together, all right, minus that off, the 218,70 gives us 6,930 in goodwill. All right, we've already got 5,400 of goodwill. We've got a premium there of 1,530. That we need to account for in our business combination valuation reserve. All right, so remember goodwill comes off in the two parts. Our cumulative dividend needs to come off. All right, so it's not so hard, but just getting there and reading through this, that's a difficult bit, making sure you don't miss anything as you go through. All right, so we've got our acquisition analysis. So what it's, what they pay, 225,000, sorry, minus the 218,070 gives us goodwill 6,950. There's already 5,400, so we have to do an adjustment there for the 1,530. Okay, so the solution to this one is already up on Blackboard, so just to make sure I explain it properly for you. Anybody have any questions to there? So it just means you have to do a little bit of extra reading. Okay, so the next bit, so step 1, done. Step 2, we have to start doing our business combination valuation entry. So all we're going to do, take all of these items here that have been tax affected and account for them. Okay, number 1, we've got our inventory, 3,600, tax component, 30% of that, 1,080. Business combination valuation reserve gets the 70%, 2,520. Depreciation, we're going to write back our depreciation. We're going to adjust our plant by 13,500. The difference between those two, the 4,500. 4,500 times by 30% gives you 1,350 deferred tax liability. The remaining 70% goes to your business combination valuation reserve. All right, so picture your little T account with your business combination valuation reserve as you're going. All right, to work out our difference when we get there, add them up. We've got our patent. We've got to add that patent in because it's not in the books of the subsidiary. That's one of the advantages upon consolidation. You can include, all right, some items that may not be in the books of the subsidiary. Okay, patents and other research and development type items are often included, other intangibles. All right, so 45 times by 30% is 13,500, the 70%, 31,500, business combination valuation reserve. We've got some research, fair value of 18 that we're going to add in. Deferred tax liability, 30% of that, 5,400. The 70%, the 12,600 is going straight to your business combination valuation reserve. Okay, the next bit is our guarantee payable of 9,000. So this is going on the opposite side. We're going to credit the 9,000. 30% of that is 2,700. And 70% is 6,300 going to your business combination valuation reserve. We also have to account for the impairment of the goodwill. All right, the question said that goodwill had been impaired. Goodwill is an asset. To impair it, we're going to have to credit it 3,600, and we're going to recognise that impairment loss, right, as part of our accumulated impairment losses in the P&L, 3,600. The difference with our goodwill, the 1,530 that we calculated earlier, all right, which is essentially our premium on our goodwill, that needs to go to our business combination valuation reserve. You can see if you forget to minus it as you're going through, you'll get your entries wrong. All right, we look at our business combination valuation reserve. We've got our inventory, so this is 70%, so these are the tax affected amounts. Inventory, patent, plant, research, goodwill. All right, our guarantee, our pre-acquisition entry there is the difference. To make it zero is 45,000. So we've got retained earnings and share capital there from the first line of our acquisition. Our business combination valuation reserve of 45, we can see from our little T account. Our shares in Lee, what we paid, 225,000. All right, we've also got a dividend payable and receivable that we need to account for of 4,500. It's an intra-group transaction. We need to remove that. So we're going to debit our dividend payable, 4,500, credit our dividend receivable, right, to zero that intra-group transaction out. All right, and that's it in terms of 10.6 and 10.7, so it's quite a lot to go through there. So we've got some intra-group transactions to go through. Now, hands up who is looking at maybe doing the CPA program? Maybe? Yeah, I'm going to do it? Yeah, well, you need to know these. All right, you need to know these intra-group transactions, so we'll go through it now. But just so you know, that you're not going to have to do a bucket load of journal entries like this in the exam, all right? So where we're going through, I'll go through the worksheet entries and you can see the money's going in and out, making sure that your group accounts only show your transactions with external parties, all right? So you need to know this, I'll go through that now, but if you've got any... there might be the odd little one that you might have to do in the exam, but none of the ones like where you've got inventory, you're selling half of it, that kind of thing, you won't need to do that. Not in this exam, it has been required in previous exams. All right, but we are focusing on the other one for this one. But let's have a look at 11.1 and then 11.3. So you've got those in front of you. So what I've just given you, this will be up on Blackboard later on in the week. All right, so you will get it after the last tutorial, so on Friday. But here, there's a little table there that I've done just for workings purposes, so you can clearly see in the books of the parent and the books of the subsidiary. So treat them independently. So each one is like the books of the parent, one's the books of the subsidiary, then you have to add them together. So you'll see when we go through, we've got the parent is koala, the subsidiary is kangaroo. And what I'm going to do is pluses and minuses with money coming in and out against maybe the bank, the sales, cost of goods sold, etc. So in the books of the parent, this is what happens. In the books of subsidiary, this is what happens. This is what the balance is. And then you add the balances together, and that's what you've got when you add them together. Are they right or are they wrong? When there's intergroup transactions, they are wrong because you can't transact with yourself. You cannot make profit by selling in between one another. So when there's a sale between a parent and a subsidiary, you have to remove that sale, right? So you remove that sale by debiting and crediting your sales and cost of goods sold and adjusting your inventory and making sure that your group accounts only reflect transactions with external parties. All right, so that would be the original purchase of the inventory because you bought it from somebody else, so you're going to have an amount in your inventory account. Right, and then when you sell that to an external party, whether it's sold by the parent or the subsidiary, as long as it's sold to an external party, therefore your inventory account should only reflect what is actually left based at the original price. All right, so you can't just sell it to a subsidiary for a markup and then they sell it and then you're showing all this extra revenue because you're transacting with yourself. It's not real. It's not real money. All right, they're just making it up. Okay, so the whole point of these intra-group transactions is to eliminate that. So we start off easy and then we'll work our way through. All right, so on the Koala owns all of the shares in Kangaroo in relation to the following group transactions. All of the transactions are treated independently unless specified otherwise. So we have to do our worksheet entries as at the 30th of June, assuming a tax rate there of 30%. So A, in April 2019, Koala sells inventory. So Koala is the parent. They've sold inventory to Kangaroo for $12,000. This inventory had previously cost Koala $8,000 and it remains unsold at the end of the period. So let's have a look at Koala. So just ignore the column with the subsidiary for Kangaroo. Looking at Koala, when they originally bought the inventory, right, you've got inventory there of $8,000 and you would have had a minus $8,000. All right, at another time when you originally bought it, right? So we've got our inventory account there, but now we're going to sell that inventory to Kangaroo. So in the books of Koala, we're going to sell it. So it was already in there. So when we sell it, we're going to have an increase in our cost of goods sold and our inventory is going to go down to zero now because we're selling it, right? We're also going to receive cash. We're going to receive $12,000 cash and our sales are going to go up $12,000. So where I have the pluses and minuses, hopefully I've got them mostly right. The negatives are just really showing a credit. All right. So that's the books of Koala. Everyone there, we bought the inventory for $8,000. It was sitting there. We've sold it and now it's zero. We've got cost of goods sold of $8,000. Cash in the books of Koala of 12, sales of 12, right? So when it comes to the end of the year, we're going to recognise part of our profit. So we've got sales minus our cost of goods sold, it's 4,000, times by 30% means that we're going to have some income tax and tax related to that. All right, so 30% on that 4,000 is 1,200. So that's sitting in the books of the parent. All right, so the transactions for the subsidiary, all right, completely separate. All they have done is they have paid $12,000. So there's a minus 12,000 and the inventory has gone up to 12,000, right? So in the books, if we're going to add the two together, so currently we've got a plus and a minus 12,000, no effect on cash. There should never be any effect on cash. Our sales, right, we've got 12,000 sitting in there, but we haven't made a real sale, have we? All right, we have got 12,000 sitting in our sales for the group when we add the two together, but there's no sale. So we're going to have to get it out, and that's where we're going to do our consolidation adjustment. We're going to have to debit it because currently sitting in there as a credit. To get it out, we're going to have to debit it. Our cost of goods sold, we've currently got 8,000 sitting in there as a cost of goods sold when we add the parent and the subsidiary together. Doesn't exist, shouldn't be there. We're going to have to take it out. So it's currently sitting in there as a debit. To take it out, we're going to have to credit it for 8,000. Our inventory account, it's currently sitting in there at 8,000, but it shouldn't be 8,000, should it? Because there's been no real transaction. It should be $8,000 because that was the original transaction with the external party. So what that means is we're going to have to credit. It's currently, when we add the parent and subsidiary together, it's only showing the amount for the subsidiary of 12, but it's overstated by 4,000. So we're going to have to deduct 4,000. Also, we have got a deferred tax asset and expense sitting in there from the parent that shouldn't be there. So we're going to have to adjust for that tax component. All right, so our journal entry, as shown here in the worksheet, debit sales revenue 12,000, credit cost of goods sold 8,000, credit our inventory by 4 and account for the deferred tax with that difference. So 30% on the 4,000 variation, which is your sales minus your cost of goods sold, which is your profit, which is going into your profit and loss, and the tax component attached to that. All right, so 30% on that 4,000, deferred tax asset debit 1,200, income tax expense credit 12,000.
Why is that sales negative 12,000?
Because it's a credit, so it's not a negative, really a negative. I just put it in there as a negative because I was doing it quickly with my pluses and minuses with my Excel spreadsheet. Treat the negatives just as a credit. It's not a minus, it's a credit. All right, so it's sitting in there as an increase in sales. Sorry, I need to fix it and do debits and credits. I just haven't had time because I've got so many spreadsheets. with the cutting and pasting. So that's all it is. So remember I said at the beginning, treat the negative as a credit. All right, and it's if it's an asset and it's a credit, then it's a minus. If it's a liability and it's a credit, it's an increase. If it's a revenue and it's a credit, it's an increase. So you can see this one here, our bank account, that's a minus. That is a minus. But for our sales, that minus there is a credit. All right, so essentially the effect of this transaction, when we add the parent to the subsidiary, our profit is overstated by $4,000, right? Because remember, you've got your cost of goods sold of 8 and what you sold it for of 12, so you're showing a profit of 4,000, which you don't want. The effect of this journal entry is to eliminate that, because you cannot make profit from transacting with yourself. All right. So what we show here in the group accounts, they must only be transactions with external parties. All right, so now that the subsidiary Kangaroo has got that 12,000, when they go and sell it, they're going to be overstating when they're selling it against that 12,000. So we have to continue to have a look at what they're selling and what they're selling it for, and remove those additional transactions for that $4,000 which has been overstated. We have to eliminate that proportion of it as you move forward when they sell it. And we only include the transactions with the group. All right, so item B over the page. All the inventory in A is sold to Cockatoo, an external party, for $16,500 on the 19th of June. All right, so our transactions in the parent stay exactly the same, right? So then in our subsidiary, we've got the added transaction to show the increase in the bank account, the increase in the sale, and then the reduction of our inventory and the increase in our cost of goods sold. Right, when we add the parent to the subsidiary, we're going to show a sales figure of $16,500, right? That is with an external party. So that remains, right? But that's our cash component. Our sales, however, are sitting at $28,500. All right, we need them to be $16,500, so we need to adjust that by $12,000, which is the original amount that when we did the original transaction. Got to reduce the sale by that. Then our cost of goods sold is sitting there at $20,000, but it's overstated. We need it to be $8,000. That was the original price of the inventory, wasn't it? The original price of the inventory was $8,000 when it was still in the books of the parent, before they sold it to the subsidiary. To get that from $20,000 to $8,000, which is also the $12,000. Right, so we're going to debit our sales, credit our cost of sales, $12,000, boom, boom, done. Right, it's happened before the end of the year, so there's no tax component because there's no tax yet. It's all happened.
I think I'm lost in 12,000 and 16,000.
Okay, so let's go back to the beginning. The parents' books haven't changed. They bought the inventory for $8,000, they sold it for $12,000. That's the same. Kangaroo paid $12,000 for it. Now they're selling it to an external party for $16,500. Bank goes up $16,500. Sales goes up $16,500. What was the original price? $8,000. All right, is our cost of goods sold. That's what it needs to show. But when we look at the books of the parent and the subsidiary, when we add the two together, sales figure is fine. Okay, our our cash, is fine, but our sales figure is overstated because we've got the original $12,000 in the sales from the parent, which doesn't exist. So we've got sales, so that's a credit, not a minus. Right, so it's a credit of 28, but we need it to be 16,500 because that's what we sold. That's what our sale was. So we're going to have to reduce our sales, so we're going to debit it by 12,000, and our cost of sales in the books of the parent, because it's still the current year, they're showing a cost of sales of 8,000, all right, which is what we need that to be because that was the original value of the inventory. All right, we're not going to use the fictitious amount that we're making up just because we're selling stuff internally, right? So we need that to be 8,000. So what that means is we need to eliminate what's happened here in the subsidiary, all right? But you add the two together because remember, these books are separate. Add them together, you've got 20,000. We need it to be 8, which is 12. Right, and this is why, if you've got the worksheet, this is why if you just do the books of the parent, what's happened, what's the pluses and minuses against our accounts, then you work out the result and then you plus and minus what the results are, what they should be. Only transactions with external parties, you can visualise it. So that's why I do up the little worksheet so you can see what they are. There are quicker ways to do it, but I find that this way is actually something where you can when you're in an exam situation, it's much easier. All right, but you don't have to, because technically in your mind, you know, you just have to eliminate the original sale. Right, so you debit the sale, credit the cost of sale, 12 and 12. Simple, so that's in the books of the parent, that's in the book of the subsidiary. Right, which are adding together. So you have group accounts. Okay, so number C, so this is a different scenario. Half of the inventory in A is sold to Galar, an external party, for 7,200. The remainder is unsold at the end of the period. Right, so what that means is we need to be showing sales. Got a cash has increased by 7,200, sales of 7,200. The original value of the inventory was 8,000. Half of it has been sold, so our cost of goods sold must be 4,000. The value of our inventory must be 4,000. So what I'm doing is I'm going to the end because we know that this is what it should be. So if you go to the end, then you can go back and work through the transactions to, you know, get there. Our tax component, 7,200 in sales minus your cost of goods sold of 4,000. What's that? 2,800 times by 30% gives you 960. So we have to adjust the tax component there. All right. So let's go back to the original. So in the books of the parent and Koala, all right, we get to the end of the year, no change, right? No, it's the same. So we've originally cost 8,000. We sold it to Kangaroo for 12. So we know we have to get rid of that original sale of 12,000. But in the books of Kangaroo, we're going to sell half of it. We get 7,200 cash. Sales goes up 7,200. But we need our sales. So we've got 12,000 in the books of the parent. Add 7,200 in the subsidiary. It gives us a sales figure of 19,200. We need it to be 7,200 because that's our sale with our external party. We have to adjust and reduce our sale by 12,000 because this sale shouldn't have happened. All right. Well, it's not so. I shouldn't say that. It's not that it shouldn't have happened. It's not a real transaction. All right. The next thing that when we look at our cost of goods sold, so originally cost us 8,000. Cost of goods sold in the books of subsidiary, remember, they bought it for 12. Half of it is being sold, so cost of goods sold is 6,000. 8 plus the 6 gives us 14, but we need our cost of goods sold to be 4 because the original price was 8,000. We've sold half of it, means that we've got 4,000 should be our cost of goods sold. So to get that to 4,000, it's currently in there at 14, we need to adjust it by 10. So we're going to credit it by 10. Our inventory account, right, our inventory was 8,000. We've sold half of it, so it's 4,000. Our group must be 4, so we've got to get that to 4. It's currently at 0 in the books of the parent because they've sold it. In the books of the subsidiary, they paid 12,000. They sold half of it at 6, so 6,000 in there. We need it to be 4. To get it to 4, we're going to have to adjust it by 2. All right, so that's debit sales, 12, credit cost of goods sold, 10, and we've got to credit our inventory 2. Then we have to account for the tax effect. So we're going to have to adjust it by 600. So the tax effect, what it should be, is your sales minus your cost of goods sold of 4,000 to give you the 2,800 times that by 30% gives us 960. In the books of the parent, we've currently got 1200, which is your 12 minus your 8 is 4, times by 30% gives you 1200. In the books of kangaroo, we've got 7200 minus 6,000 is 1200, times by 30% gives you 360. 360 add to 1200 gives you 1560. We need it to be 960. To get it to 960, we have to adjust it by 600, right, which is also 30% of the 2000 inventory overstatement, which is in there. All right, so I've gone the long way about doing it, but I'm just showing you visually. This is the books of the parent, that's what's in there. This is a subsidiary. When we add the two together, this is how much it's overstated by. This is where we need to get it to. Right, it starts to get a little bit tricky when they bring in markups and all that kind of stuff. And you're selling 1/3 and okay, but you get the hang of it. It's not so hard, is it? And once you get the hang of visualising it here, right, it becomes quicker. All right. Item D, koala in January 2019, sold inventory for 8,000. This inventory had been sold to it by kangaroo in the previous year. So because it happened in the previous year, we're going to have an adjustment to our retained earnings, right? Because if we go back here, even though this is a different question, right? Remember, we've got sales minus cost of goods sold and we've got a tax component. We're going to have money that's going to go to our retained earnings. So we've made a profit, goes to our retained earnings. So we're going to have to do, it's not that question, this is a different question, different amounts, but just showing you the effect of it. So it had originally cost kangaroo 4,800, right, and was sold to koala for 9,600. So we've doubled the markup, so it's been overstated by 4,800. We're going to have to adjust our cost of sales. We're going to credit it by the extra, which is your 9,600 minus 4,800. Cost of sales, credit 4,800. 30% of that, 1,440, and the difference goes to our retained earnings because it's in your retained earnings of the previous year where the movement with your sales and your cost of goods sold is. All right, but we have to write out the extra. They've sold it to an external party, so that bit's gone through, but to eliminate the internal transaction is the original cost, 4,800. What they sold internally for was 9,600. The difference between those is 4,800, so that's how much it's overstated by. All right, so our cost of sales, we have to adjust that by 4,800. All right, so 11.3, it starts to go a little bit different. So do you want me to keep going through the rest of them, or you're right? Okay, so 11.3 over the page, we've got a new parent and a new subsidiary. Okay, so Dingo owns all the shares of Bilby. So Dingo is the parent, Bilby is a subsidiary. So again, all parts are separate unless otherwise stated. We got a tax rate there of 30%. So in A, on the 1st of January 2018, Dingo sold inventory costing 6,000 to Bilby at a transfer price of 8,000. So it's overstated by 2. On the 1st of September 2018, Bilby had sold half of these items of inventory back to Dingo, receiving 3,000, so it's gone back to the parent. And of the remaining inventory kept by Bilby, right, and half of this was sold in January 2019 to Goanna at a loss of $200. All right, so in the books of Dingo, they sold inventory costing 6,000 for 8,000. Half of this, right, goes back to Dingo. So 4,000 of that. So the original price is 6. All right. the transfer price, so we're going to go, half of that goes back at 3,000. So in the books of Bilby, they've currently got 4,000. They're going to sell it to an external party at a loss there of 200, another half of that. So half of that is 2, so it means they've received cash of 1,800. You with me? Hang on, I haven't got a thing. Okay, so books of Bilby, they've got paid 8,000. So we've got to account for the internal that later. We'll do that in a minute. So they've got 8,000. Half of it goes back to the parent, right? So 8,000, half of 8,000 is 4,000, right? They're going to sell half of that again. Half of the 4,000 is 2 at a loss of 200. So it means the cash component is 1,800, right? 1,800. So let's have a look at the question. So let's have a look at the first part of the transaction. So Dingo has sold inventory costing 6,000. So inventory, the 6,000 must have been in there already. It's come out, cost of sale 6,000. The sale, we're going to sell it for 8,000. Sales goes up 8,000, cash goes up 8,000. The books of Bilby, inventory goes up 8,000, your cash goes down 8,000. All right, so that's just up to that point. In our books of our parent at that stage, we've got an income tax expense of 600. All right, so that's from the 1st of July 2017 to the 30th of June 2018. All right, so on the 1st of September 2018, so notice it's in the next financial year. All right, so this is why we've got to do it in 2 parts. So in the next financial year, let's do our adjustment in the books of Bilby. All right, so we're going to, in the books of Bilby, we are going to sell for $3,000. So we're going to sell half of it for 3,000. So in the books of the parent, the inventory is going to go up 3,000 and your cash is going to go down 3,000. In the books of Bilby, your cash is going to go up 3,000, your sales is going to go up 3,000, and your inventory and cost of goods sold is going to go be adjusted by 4,000 because you sold half of it. All right, so it's in there at 8. Half of 8 is 4. That's the first transaction. They've sold half back to the Dingo. But then they're going to sell half of the remaining half, all right, to an external party for 1,800. So we've already calculated that 1,800. Bank goes up 1,800. Sales goes up 1,800. Half of the 4,000 remaining. Cost of goods sold goes up 2,000. Your inventory goes down 2,000. All right, so in the books when we add the 2 together, we have got 3,000 sitting in the books of the parent. We have got 2,000 sitting in the books of the subsidiary, giving us 5,000. All right, but what we need to do is to make sure that in inventory, we've actually only sold 1/4 of it, haven't we? A half of a half is a quarter. So our inventory needs to be equivalent to 3/4 of the original value. The original value was 6,000. 3/4 of 6,000 is 4,500. All right, that's what should be in the group. All right, our external party, our cash component, 8,000 is correct. Our sales is correct. We have sold 1/4 of the original 6,000 of 1,500. All right, and then we can work out our tax. So we've got the sales minus your cost of goods sold gives us 300, so 1,800 minus the 500, 300, times that by 30% is $90. That's what we need it to be. All right, how do we get there? Let's have a look at our sales. We're going to have to adjust our sales. It's currently in there at 4,800. We need it to be 1,800. We're going to have to debit it by 3,000. Our cost of goods sold is currently in there at 6,000. We need to make that 1,500. We're going to have to adjust that by 4,500. And our inventory, we've got 5,000 in there. We need it to be 4,500. We're going to adjust it by 500. All right, to get our tax component correct, we have got money sitting in our retained earnings. All right, from the sales minus your cost of goods sold, 8,000 minus your 6,000 is 2,000 minus your tax, 600, gives us our retained earnings there of 1,400. So we're going to have to do an adjustment to that of 1,400. And we're also going to have to do an adjustment to our income tax expense. All right, we need our, this is the first journal here in the blue. All right, so we're going to have to do that adjustment 30%. Of that 2,000 is the 600. All right, from that inventory, we'll come back. All right, to get that down to 90, we've currently got a deferred tax asset in there of 600. In the books of subsidiary, we're going to be showing an amount in our income tax expense and our deferred tax asset there of 360. We need them to be 90 to get them back. We're going to have to do an adjustment there of 150. So I can't fit it all on one screen, so let's go it through here. So in here, this is our journal entry. So we've got 3,000 in our sales, 4,500, 500, 1,400 and 600 is our first one. So we're going to have to do an adjustment to our retained earnings of 1,400 because that's recognising an unrealised profit from a prior year. So that's your 2,000 minus your 600 tax component is your 1,400 that was sitting in retained earnings. We have to eliminate that. Our income tax expense, so that 30% on that 2,000 of 600, we have to adjust that. Sales revenue, we've got to adjust that by 3,000. Our cost of sales, we have to adjust that by the 4,500. And our inventory, 1/4 of the 2,000 of 500. Right, don't forget our final adjustment, 1/4 of that 600 needs to be adjusted as well, which is your 150. Okay, all in an effort to show only the transactions with external parties. All right, so it takes a bit to get there, but you can see your pluses and minuses, making sure that our group accounts only reflect transactions with external parties. Okay, so it's a little bit in that one, a bit complicated. B, on the 1st of January, Bilby sold an item of plant to Dingo for 2,000. Immediately before the sale, Bilby had the item of plant in its accounts of 3,000. So selling it for a reduced price. So we need to account for the depreciation on that one. So Billy depreciates at 5% per annum on the diminishing balance, and Dingo uses a straight line method over 10 years. Okay, so here we've got to bring back our plant, so it should be in our books at 3,000. All right, it should be in our books at 3,000. It's no longer in the books of Bilby. They've sold it to Dingo. It's in Dingo's books at 2, but it should be in our books at 3. So we're going to have to increase the value of our plant by 1,000. We're going to have to remove the proceeds on sale of that plant, debit the 2,000 and credit the carrying amount of plant sold. All right, so that's one journal entry that you could do. So this is what they use in industry now. They do use these accounts, proceeds on sale of plant and carrying amount of plant sold. If you use gains and losses on sale of plant, then you would do this journal entry. So it depends on what line items you've got as to what you debit and credit, but the effect is the same. So it's either or. So but regardless, plant is understated. We have to increase it by 1,000. If we use the proceeds on sale of plant and the carrying amount of plant sold, we need to write that back. So we need to reverse that. And in the second one, if we've recognised the loss, we need to, so remember, losses are debited. So to remove it, we're going to have to credit it by 1,000. Right, so it depends on what accounts you use. Both are acceptable. Has the same effect. I've kept it as the 2 separate ones because that's what industry primarily uses. All right, they separate them out. Don't forget the tax. All right, so there's an income tax component, so 30% of that 1,000 we have to account for. So we're going to debit our income tax expense, credit our deferred tax liability by 300. Depreciation into future years, we're going to have to increase it. Because it's understated in the books of subsidiary, they're not recognising enough depreciation. So this time we have to increase it. So depreciation goes up 10% on $1,000 for half a year. All right, it's not for a full year, so it's $50. So 10% of 1,000 is 100. Half a year is $50. So debit the 50 because of the timing of the transaction. So from the 1st of January to the 30th of June, 6 months. Okay. We've also got to account for the deferred tax liability on that depreciation. So 30% of that $50 is $15. Okay, that's an easy one actually. Okay, the next one, item C. Again, we've got another motor vehicle, but this one it's slightly different. So on the 1st of July, Dingo sold the motor vehicle to Bilby for $12,000. This had a carrying amount in Dingo of $9,600. So we know that it's currently overstated by $2,400. So in the books of one, it's been added to the books, and the other one, it's been sold. So we need to remove that. The proceeds on sale, we need to take that out, $12,000. The carrying amount of the vehicle sold, $9,600 in the books of the parent. The motor vehicle, it's currently in there at $12,000. We need it to be at original value of $9,600. So there's a difference of $2,400. All right. Or if you use a gain on sale account, we need to remove that gain, debit the gain, credit the motor vehicle, $2,400 because it's overstated. Okay, don't forget the tax component, so, well, the depreciation and the tax, all right? So the variance there is $2,400. We have to account for the tax on that. So 2,400 times by your 30%, 720, your deferred tax asset. Then we've got our depreciation, which is at 10%. So 10% times by 2,400 is 240. Tax effect on that depreciation, we've got 30% on that 240. All right, or equivalent, the tax component here that we're going to write back, the 720, 10% of that, 72. Okay, so 30% of 240 or 10% of the 720. All right, because essentially we're going to be writing that back over the next, all right, 10 years. D, during the 2018 period, Dingo sold inventory to Bilby for $9,000, recording a before-tax profit of $1,800. Half of this inventory was unsold at 30th of June 2018. All right, so half of that 1,800 we need to adjust. All right, so we need to adjust that 900 cost of sales, which is overstated. So half of the 1,800, 900. The tax component of that is 30% of 270, and the 630 relating to the sale in the previous year, 630 needs to be accounted for. Okay, so that 1,800, so we need to account for that. Now the next one, E, Bilby sells second-hand machinery. Dingo sold one of its depreciable assets, original cost of $80,000 with depreciation of $64 to Bilby for $10,000. So 80 minus the 64 is 16, so there's a $6,000 variation. On the 1st of January, Bilby had not resold the item. Right, so this one here can get a little bit tricky if one treats it as a machine and the other one treats it as inventory. All right, we need to make sure that we use the correct accounts. So, depending on how they treat it, but we know it's overstated by 6,000. Right, so if it's in the books of the inventory of the subsidiary, we need to adjust that inventory. All right, so we need to remove, increase the value of that inventory because the original value was 16,000, so they sold it for less, so we need to recognise it at the greater amount. So we've got to debit the inventory of thousand, so it's in there at 16,000. We need to eliminate the internal sale, so we debit the proceeds on sale of machinery and credit the carrying amount of the machine sold, 16,000. All right. We could also do it this way with the loss on the sale of the machine, like we did before. But don't forget the tax. 30% of that 6,000 is 1,800. Debit the income tax expense. Credit the deferred tax liability. All right. If it's selling the item as inventory, it's not going to depreciate, is it? If it starts to use that as a piece of machinery, then we need to account for depreciation, but it's not. So it's gone from machinery in one to inventory in the other. Because the purpose has changed, we're not going to account for that depreciation. If, over the page, lucky last, on the 1st of May 2019, Bilby sold inventory costing $300 to Dingo for $360 on credit. So it's not going to affect your bank account straight away. We're going to have an accounts payable down here. So all we do is go through the same process, but we're going to put it into our accounts payable. All right, so Bilby sold inventory. So Bilby, the subsidiary, sold inventory costing $300 for $360. All right, on credit. So we've got sales up 360, accounts receivable goes up 360. In the books of the parent, your accounts payable goes up 360 and your inventory goes up 360. Right, so half of these goods had been sold by Dingo, but then they had paid back $280. So let's do the payback first. So our accounts payable, there's a transaction there of $280, an internal transaction. All right. On the 30th of June, half of these goods had been sold by Dingo. So they bought them for $360, so they're going to sell them. So what I've done here in this example, we don't know how much they sold them for, so I just did it at cost. All right, so we've got inventory is going to go down by 180, sales is going to go up. Your cost of goods sold, your cash goes up 180, sales goes up 180, inventory goes down 180, cost of goods sold goes up 180. All right, so we just did it at cost. Now, in the books of the subsidiary, we have got the original transaction and of 360, and then the original cost of 300, but we've also got the cash component. So the parent has paid $280. So we have got cash goes down 280, accounts payable goes down 280. In the books of the subsidiary, their cash goes up 280 and their accounts receivable goes down 280. Right, so what we need to reflect in the group is the fact that the original value of the inventory was $300 and we've sold half of it. So it should be in there at 150. All right, so if you have a look at your inventory is in there at 150. Your sale to your external party, assuming we sold it at cost, it should be 180, and your sales is 180. Your cost of goods sold should be 150. All right, in order to get to that, let's do our adjustment. Our sales revenue, we need to minus out the original sale of 360. Right, that's what they sold it for. It didn't exist, so we're going to debit that sales revenue 360. Our cost of sales of 330, and our inventory is going to credit there by 30. All right, so currently in the books 180. We need to get it to 150. We need to reduce it by 30. Our deferred taxed asset, $9 is 30% of that $30 on the inventory that we're accounting for, and our accounts payable, accounts receivable, we need to make sure that we adjust for that. All right, because we need the whole lot to be removed. So when we add those two together, we've got $80 sitting in there, but there should be no accounts payable or accounts receivable. So we need to remove $80, which is your 360 minus the 280. That's what's left. All right. Keep calm, good luck, practice, practice, practice. But remember, as I've said before, it's not about luck, it's about hard work. Practicing. Any other questions? This is it. This is the last class. Anyway, good luck. Study hard. Good luck for all your exams. Just be really smart the next couple of weeks what you do and try not to get sick. If you do, then that's just, it is what it is. Make sure you get a medical certificate if you're not well enough to sit the exam. Don't do what I did in one of my last exams. It was actually my very last exam. I had chickenpox. And I couldn't bear to wait for, because when I was doing it, they'd make you wait a long time. They usually make you wait until, you didn't have to first, you had to sit it the next semester. So you had to wait 6 months before you did your exam. I couldn't bear to wait that long because it was my last unit, so I did my exam with chickenpox. I just put makeup over everything and pretended to let anyone know. And my grade was probably only about 10% lower than what I reckon I probably would have got anyway, but I was actually really sick. It was a consolidation exam too. Alright, so don't wish that on anybody. But I was a real nerd at that time, so I just always studied hard, so I knew it all anyway. But yeah, don't do your exam if you're not well. Get a medical certificate. You don't have to be a hero. All right, good luck.
Thank you.
Thank you. Thanks for having me for the last 14 weeks. I hope you've enjoyed yourself. Yeah, consultation. It's on Blackboard. I'm going to put up my barns as well, so I'll be in next week. And then periodically, because you're in the second week, I'll just wait and see what people want, whether I come in or not. But you know I'm pretty accessible. And if you need me to give you a ring back, I can do that too. If you don't want to just do it on email, I can give you a call. But just make sure you can book in a time for me to call you or something if you want me to. All right, if email's not enough. All right. Thank you.
Thank you.
I didn't really brush it. Because I don't have to carry it. Sorry. That's all right. Okay. Thank you.
Thank you.